Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
Well, welcome to today's show. Today's guest is Swapnil Agarwal. Swapnil is the founder and managing principal of Nitya Capital based in Houston, Texas. Since its inception, Nitya has acquired over 17,000 units and 1 million square feet of commercial office space and currently has $2 billion plus of assets under management. Swapnil, welcome to the show.
Thank you so much. It's a pleasure to be on your show.
Thank you. Well, let's jump right in. Walk us through your background. Tell the listeners a little bit about yourself.
I was born and raised in India. I came to the United States as a young immigrant. I was 15 years old. I moved to Houston with my parents. Started in my 10th grade in southwest part of town in A.D. Hastings High School. And, just like any other immigrant, went through the normal challenges when you move to a new country, especially with a country coming from a small town in India to a big country city like US and Houston. It was challenging, but when you come at that age of 15, I think your mind is ready to adapt and go through those challenges in a pretty good way. And my parents actually had a harder time, except getting adjusted to the American culture. But my dream was always that when I came to this country, I only had one goal. My goal was to make my parents proud. My goal was that I wanted to justify the move they had made. And, for them, they were mid-40s, late 40s, and moving from, they've never stepped out of India before in their lives, and coming to America and working in, convenience stores and having some of those tough jobs. My dream was just to make sure that their move is justified and I make them proud. And I started working towards that. And I don't think I was smart enough to be an engineer or doctor, which most of the Indian people, parents push their kids to be. And in my case, I was driven by, I loved economics. I love finance. I love numbers. And that's what I decided to do. I decided to major in finance at the University of Texas. And I worked at various local pizza shops in Houston to pay for my college, and then, I was fortunate enough, to get an investment banking job at Simmons and Company for the first 2 years out of the college. And then I took a, industry change. I went into real estate private equity and I moved to Hong Kong in 2006. At the age of mid-20s, I was given in charge to lead head the Asia office for a $600 million fund,
Wow.
Which was pretty amazing for me. And I went there, I was there for 7 years. It was an amazing experience. Not only just learning about real estate, but just learning about different cultures and, learning about that when you are making an investment, it's more of an investment in people versus investing in actual deal itself. And then, I was ready to come back in 2013. My wife and I were expecting our first child. And we made a move back to US and Texas. And that's when I said, look, I always wanted to be my own entrepreneur. And we started with the basic thesis of providing nice, clean, safe place to live, which is affordable, which is where I grew up for the first 10 years of my life in Houston. And actually worked at a lot of these apartment complexes, passing out pizza flyers. And so it was kind of a surreal feeling with getting an opportunity to buy these deals. And I was fortunate enough that I kept getting introduced or kept meeting people who were very good, who were able to help me with raising equity or helping me with getting the debt, because, raising debt is not easy in 2012-13 timeframe, especially because I didn't have much net worth. My savings were about $300,000, which I had saved up working 10 years in corporate America. So, from there to here now, we work very hard. We have a fully vertically integrated platform, that not only buys, executes, raises equity, but we also manage and do our own construction in these apartment complexes.
Oh, that's an amazing, amazing story. So, walk us through your vision for your business and what you're trying to accomplish in the next 3 to 5 years.
Yeah, look, I'm not the one that really likes to plan a lot of things. All I know that I just want to be one of the biggest and the best real estate platforms in America. And I said that when I had 0 apartment units, and I'm still saying it when I have 20,000 apartment units. And people used to laugh at me more when I had 0. People don't laugh at me that much when I have 20,000. That then maybe this guy has a chance that he can do it. So my vision is not in terms of numbers. My vision is I want to be the best management company. And we all know me, you're in the apartment business. Managing and operating these assets is probably the hardest part of the job, right? And there's no easy answer. There's no shortcuts. It's all pure, tedious, laborious job because you're dealing with people. You're really dealing with families where people are, growing their kids up and they're living. It's their home for them. And if there's anything that's wrong, I mean, there's so many aspects. It's so fascinating when you talk about property management, right? You have, you're not only you're dealing with investors, but then you're dealing with lenders, you're dealing with accountants, you're dealing with vendors, supplies, and then you have your own employees, which in my case over here 800, and then you have the families, your tenants, your clients, which you're trying to satisfy their needs. So it's so fascinating when you cover so many aspects of it. And I've not seen a company, and including mine, we're not at that point where we can say, okay, we are the best management company, right? My goal, my vision in the next 3 to 5 years, to answer your question precisely, is when you hear of Camden, when you hear of Gables, people associate that brand name for a nice, a nice apartment complex community in a nice area. I want to have that vision for Karya. I want to have, when people hear of Karya, I want people to associate that, okay, this is going to be a great apartment community with great service, but very affordable. So good value for money. So I want to create a niche in the workforce housing space, in Class B and C space, where people identify with the brand name Karya.
That's great. No, I appreciate that. And so with the units that you manage, how do you continue to grow, and what teams and systems and software do you leverage to execute your business plan?
Yeah, we are big on technology, right? So we have a whole IT department, we have a whole marketing department, and the times have changed, since I started the business, where your marketing was, okay, print out the flyers, go and pass the flyers out at various spots. Now it's all digital. Now it's all social media. Doing virtual tours, accepting payments. We don't accept any payments on at the property level. Everything is online. We partnered with a lot of these grocery stores where people can pay through money orders, through e-money orders. And then having, the pricing models. I mean, there's plenty of pricing models that exist in the market, the LRO models that people call it. But we're building our own pricing model. I mean, it's just like any other industry, like airlines or hotels. There's nobody sitting there manually changing prices. It's all artificial intelligence, all algorithm driven. So we are building our own property management software. We are building our own pricing software, which basically that's what we're trying to solve is what can we do to make sure that our properties are priced optimally at the best level at any given point.
Okay, no, that's great. And then if we turn to COVID-19, how are your properties performing during this crisis?
Yeah, we are actually very fortunate. Today is April 29th, and I think we've collected almost 99% of last month's rent. Wow. And March was actually, to be very ironic, ironically enough, was one of the best months we've had in a long time, in the last 12 months. And I thought April, for April to get close to March, we're very fortunate. So we are doing extremely well. Obviously we are very mindful of the expenses at this point, cutting back any capex, cutting back any R&M, wherever we can save. So in fact, at the NOI level, which is what everybody should look at, but people focus on the collection, NOI will in fact be better than March.
Okay, because of the expense reduction.
Yeah.
Yeah, no, that's great. And then are there any trends or patterns that you're seeing in the marketplaces and the submarkets that you have assets?
Yeah, one general trend I've seen is it's pretty funny because with all the fiscal and monetary stimuluses that the government and the Federal Reserve announced, I would say that a lot of the tenants, a lot of the workforce housing tenants, I would say actually are making more money than they actually were when they were working. So now it's up to them if they want to use it to pay their rent. But given we are the essential need, which is having a house over a home, over their roof over their head, I think we're seeing, there's people who are saying, okay, I don't want to work anymore. My unemployment benefits, I'm getting $1,000 a week, 600 from federal, 400 from the state, plus I get a $1,200 check. I mean, I'm making more money without working, and then that goes on for four months. So it's interesting times. I mean, again, in Houston, we have a double whammy about the oil prices, so that remains to be seen how that plays out. But we've been through that before in 2015 and 16, and
Sure.
And frankly, our property's occupancy went up during that time because a lot of people downgraded. A lot of white collar jobs were lost. So, we're seeing it. So it's I would say it's too early to say. Let's see how May and June plays out.
Sure.
But based on my theory and what I'm seeing, I think it's going to be a V-shaped recovery. I think that Houston is getting opened up, or Texas is getting opened up this Friday in a limited capacity. I think people are just itching to go back out there, right? I mean, people are just staying at home. People want to go out, spend money. The retail, movie theaters, restaurants. So I would say there's a lot of pent up demand, and I really certainly do hope that this is a V-shaped recovery and we all bounce back really fast.
Yeah, I think we all hope for that. That's for sure. And then what advice do you have for investors and operators dealing with these challenging circumstances?
That's a very broad question. So I would say that anybody in the real estate or this multifamily field, I would say that it's all about operations and your management, right? I mean, it's just how you deal with, how you motivate your staff, how do you care for them. One of the first things I did when we faced this 6-7 weeks ago is I promised to all my tenants that, or my employees, that they will continue to get paid no matter what happens. And I got so many good messages and emails from them that they were so thankful that they knew that their paycheck will keep coming. And that plays a big role. I mean, you have your leasing agents or your assistant manager trying to collect rent, and they know that if they have a CEO or a boss that's going to continue to pay them, they will work harder, right? So take care of your people, take care of your tenants. I don't know if you guys know, but I announced a $4 million rental assistance fund, which will basically pay up to $1,000 per month for people who had lost jobs. So we announced that through our nonprofit organization called Cardiac Cares.
That's great.
Then we also did, we also contributed about $300,000 to fire department, police department, the sheriff department. Since they are the first responders, their safety is of utmost importance to us. So we want to make sure that they are feeling safe, so they have their PPE gear before they can go out and do their jobs. So these are the things, moments like these, it combines, unites humanity, unites people, makes everybody closer to each other. Because look, end of the day, we all are fighting the same battle, right? There's no winner or losers here. People can only do what they can. And one advice I would give people is, let's not worry too much about future. Do what you can, it's in your control, and then leave the rest to the God, right? Because we don't know what's going to happen in May. We don't know what's going to happen in June. We don't know if virus will come back. Let's just do what we can, what's in our control, and let the rest take care of itself.
Yeah, no, that's great advice, and it's a great, inspiring story. And then if we look a little bit more at Houston, what's your outlook for multifamily in Houston?
See, Houston is an interesting place. I've lived all my life since I moved from India. Look, Houston economy is still dependent on oil and gas, right? I mean, we say it's almost 1/3. So as a general case, if the oil stays this low for this long, I would say, there will be a lot of job losses, right? I mean, we were saying 200,000, 300,000 job losses. But again, it's one of the most affordable places to live. There's still population growth of over 100,000 people moving to Houston every year. So, in the sector we are in, I think it should be kind of very recession resilient, even if the oil prices continue to stay low. But look, Texas or US can't survive. I mean, neither can the world with the oil being so low. The demand has to get back up. People start going back to work. The oil will go back up. And I think in short term, we might see some challenges, but again, that's when your operations or execution comes in handy. Over a long term, again, I'm very bullish. I'm a native Houstonian, so I love Houston. I think Houston is a great place to live and do business in. One other thing I would say is the property taxes. I know one thing that always blows my mind every year is when property taxes come out in Houston and the Fraser District or Harris County releases their values. It's just such a big black hole. Every year they come out, release values that are 100, 200, 300% higher, and then you have to fight those taxes. And I just wish that there's more clarity on their methodology. I wish there's some sort of a cap, especially this year. if with the wire situation and the oil prices, I really hope they come back, the Harris County or the Fraser District comes back out and puts a cap on the property taxes for this year. Because, look, if property taxes go up by what the initial values are released, I mean,
Sure.
that's going to be a single biggest factor the city will enter a recession.
Sure. And then are there parts of the space that you think will underperform or outperform during this part of the cycle?
Yeah, I mean, obviously, look, retail is going to be hurt the most, right? Retail is, it's, anything in the retail side, the malls. Hotels is a great time to get into hospitality. I'm starting to look at a lot of deals in the hospitality sector. I feel there's going to be great deals coming out of it. And, you got to be opportunist, right? You got to be an opportunistic investor and entrepreneur, especially times like these. I think that's going to be one great area where you can pick up some good deals from the lenders in foreclosure. Multifamily should do well. Industrial should continue to do well. Commercial, again, we have about 1 million square foot of office space. We haven't seen any requests, any meaningful requests from tenants for rent abatement. But again, even though our oil exposure in the commercial space is about 25%, if it lasts for over a year with the oil price being under $20-25, I mean, we will see challenges in the commercial sector as well.
And then if we focused on multifamily, what type of price reductions and changes in terms do you think you'll see in Houston?
It is very hard to say. Look, it depends on the debt environment. It depends on your loans, right? So, look, interest rates are basically zero, right? Now the spreads have widened up. So it depends. Right now there's not much activity. I mean, obviously the agencies are still lending, but there's a big line. There's a big queue, people trying to borrow. But look, if CMBS market opens up, if the bridge lenders are back and the agencies are continuing to lend, and if the interest rates are so low, if your cost of debt is low, I don't think there will be a price reduction, right? I mean, it's a function of your cost of debt and cost of equity. So now I know the equity is like, okay, if I'm taking on this risk, I need to justify a higher cost of equity. Now, I don't think that's going to happen. There's so much liquidity out there in the market. If people don't get aggressive fast enough, and we saw that in the equity markets, the stock market, people were waiting when it's going to retest the lows. I mean, look, market is back up to, it's just 10% low to the all-time highest.
Sure.
Right? So same thing I expect. I mean, people might be waiting and it might never happen. Just like last time in 2015-16, people were waiting on the sidelines because oil had dropped below 25 or 30 bucks. And people kept waiting. And that's the time we got aggressive because we felt like it's a great time to buy. And we accumulated and it turned out pretty good. So if people are waiting, there's going to be a meaningful price reduction. I don't think that's going to happen.
And what's been, just walk us through, on the acquisition side, the first deal that you did and your mindset and vision for, scaling that.
The first deal I did was a very small apartment complex in Houston, 160 units. Look, to be honest, man, I didn't know what I was doing. Here I was, coming from a private equity shop, sitting in a nice high-rise white-collar job, traveling business class everywhere across Asia Pacific. And here I am sitting in a class, D minus, the best way to put it, apartment complex, a very rough part of town. And literally, when I bought the property on paper, the occupancy was 90%. When I took over, it actually turned out it was 65%. It was 20 air conditioners that were stolen by the old owner. Wow. And first 3 months, I thought it's the worst mistake of my life. Here I am sitting in a really, really bad property and scared for my life. And I'm scared to step out to collect rent. I have to wear a bulletproof jacket. So it was a tough deal, but again, that's when your hustle, that's when your entrepreneurship, that's when your never give up attitude comes. And, if within 6 months, we were able to bring the occupancy back to true 81%. And, we bought it for $20,000 a door. And to be honest, when I paid $20,000 a door, I had people telling me you're overpaying for it. And I said, well, overpaying $20,000 a door. I mean, what do you pay? He's like, well, I would have paid 13. I said, 13. That's pretty amazing. So I said, if I'm overpaying for 20, maybe I just made a really bad. I mean, how can somebody say I'm overpaying $20,000 a door? Look, we stuck with it and we sold it for 35 a door, and today it's probably worth 75 a door, right? So it's just history to repeat itself. And so you gotta trust your gut. You gotta have passion about what you're doing, and the rest will fall in place.
And so this is an amazing story. So what was the investment thesis? What was why did you decide that apartment complex and kind of the scaling behind it?
Investment thesis was very simple, right? on paper, is 90% occupied, 160 units. It was collecting about, on paper, supposed to collect $85,000 gross income. I paid 20 a door. So on paper, it worked out to like 9 cap rate, right? So 9 cap rate, that's pretty solid. I'm borrowing at 4.5, 5, whatever that was, or 6 at that time. And I said, look, I'm going to generate 10% cash in cash, which is what I told my investors. And there's, I had to raise $1.4 million. I found a few people that love cash flows, and we were just starting that cycle of the value add term that didn't exist back then, but now everybody knows value add, what
Sure.
value add is. My value add was, okay, I just want to clean up the place, provide a nice, clean, safe place to live. And that's what I did. But then it turned out it wasn't really a 9 cap, it was like a 3 cap. But then when the occupancy went up, it turned out that it worked out.
It went back to a 9 cap, I guess.
Yeah, and it underwrote well for the new buyer.
And so, each day that you went there for that period of time, what was your mindset, your vision each day to get up and say, hey, despite the ivory tower I just walked away from, I'm here at this apartment complex. This is the bed that I made and I'm going to sleep in it. So just walk us through kind of the mindset mentality.
Yeah, like I said, first 3 months were very tough. But then, once I started to get some sort of confidence and, started seeing changes for the better. And then at that time I got excited, right? And I said, look, I can do this, and I'm going to do it. I have to scale it very, very fast, right? I'm going to have to scale it at a really, really fast level. And that's what got me, excited every day I woke up, right?
Mm.
So not only I was managing this asset, and I kept growing my team, I kept hiring people I liked and trust. And then I kept looking for new opportunities. So the next property I bought was 176 unit in July. Then I kept buying another 185 units, and I bought September. So I got excited because I knew the window was very short. The timing was key, because at that time you were paying 20, 25, 30 a door.
Sure.
And all we know now, those same properties trading for much higher. So, that's what got me excited, right? Raising money at that time. And I got people to manage this thing for me, the people I trusted. And then my task became, okay, look for opportunities and raise money. Look for opportunity, raise money.
Sure.
And for the next 3 years, that was my routine. And then now this is what, now we're going back to the original cycle where we have so much mass. We have about 2.5 billion of assets. Now we're again focusing on management operations.
Sure. No, that's great. And then what were your biggest lessons learned as you were scaling your business?
Biggest lessons is never take anything for the face value, right? You got to do the hard work yourself. For any entrepreneurs, I would say that the biggest learning should be that, don't be afraid to take risks, right? You got to take risks to make it big. Don't get sidetracked by the paycheck security, as we call it. Like, oh, I got every 2 weeks, I'm going to get a paycheck. How would I do it? Look, you will do fine. Like, just stay at it and work hard at it. And the lessons are, business is fun, right? If you're an entrepreneur, there's no other job like that. But it's the most stressful job and the most fun job at the same time, because literally your destiny is in your own hands. You're not answering. People say I'm not answerable to anybody, but in fact, I'm answerable to everybody. I'm answerable to my investors. I'm answerable to my employees. I'm answerable to my tenants. Sure. But do it with the fun. Do it with passion. So another thing I would say is don't wait. A lot of entrepreneurs, like 99.9% people you meet, I bet everybody say they want to do a business, but only 0.01% end up doing a business. And the main reason is 99.9% people are looking for that idea, looking for that home run idea that, okay, I'm gonna be the next Facebook or Google. I'm gonna create something that nothing is done. I would say get away from that and do something that's already exists and do it better, right? Mm-hmm. So apartment company, everybody knows about it, right? But just do it better, manage it better. That's my value add, right? Raising money is not the easy, it's not the hard part. The hard part is operations. Mm-hmm. Pay attention to your track record, right? Be humble, be transparent, perform with highest integrity, right? Never take shortcuts, because if you perform with the highest integrity you put investors' interest at first, I guarantee you, if you make investor return, they will give you more money to invest, right? So always keep that in mind.
No, that's great. Great advice. Great advice. And then just walk us through how your multifamily acquisition strategy has evolved over in time in terms of the assets that you acquire and maybe even the financing that you might use now.
Yeah, look, it's a general progression. When we started buying, we're buying smaller units or smaller deal sizes, under 150 units, under 200 units. And now, as we scaled up, we're looking for 30 million plus deal sizes, and for us to make sense, of it. Also, we've grown in other geographies. So we're not just Houston. We have pretty large portion in Dallas, Austin, San Antonio, Kansas, Missouri, Kansas City, Utah, and Las Vegas. So we've expanded geographically. We've increased the deal sizes. Then we've also gone into other asset classes. We have a single family homes flip fund as well. We have exposure to mixed use retail and commercial assets as well. So, we continue to expand. We continue to get better on the operation side, and on the financing side. Look, we look for the best for the deal itself. So if it's a value add, a heavy value add, we look for bridge loans. If it's decent value add, then we'll do agency debt. So
okay.
that's yeah.
And is there a typical business plan that you employ for an asset?
It's deal by deal. So sometimes we buy a deal, could be a coupon clipper if it's a great cap rate, which is hard to find these days. But like late last year, we bought a deal in Laredo. I mean, it's a Class A in a 2014 build, 450 units. We bought it at 6.5 cap rate. We put 3.5 fixed debt, CMBS debt, 10 years IO. So look, we're not going to do any capex on it. It's a nice 10-12% cash on cash. So we'll continue to do that. But then there's heavy value add lift. We bought a deal in Austin in December. Great location, but it's 100% units needs to be rehabbed. So it's, again, depends on
it depends on the asset.
Yeah.
And then in terms of the assets that you like to buy, is there, it sounds like you have a different strategy for each asset. Is there something that gets you excited about a deal? Are there certain things that, you look for when you're acquiring an asset?
Yeah, I always look for the story, right? I always look for who's the owner, who's the management company, why are they selling? And, being in the business now, and a lot of the brokers know us. And, for me, it's always about the story, right? So but there are certain management companies or names that, they are managing it. I get excited. Okay, I'm going to buy that for sure, right? Because there's definitely room on the upside on the income. And obviously the location, real estate is always about geography, location. And now, we have assets in pretty much every submarket in Houston, especially, and major submarkets in Dallas and Austin. So we have our own data that we can look at, right? If there's like we're buying an asset in San Antonio, is a broken process because of the coronavirus. The buyer backed out. We stepped in at much cheaper price, and occupancy is 58% in the medical center. And we have a property right down the street that's 92%. So
wow.
we look at that data and we say, okay, look, it's just mismanagement on those.
Sure. No, that's great. And is there a quick way for you to screen deals?
So we have a big team. Yeah, we have a big team now. So we have, we have a finance, asset management, acquisition department. We have a team in India that can analyze deals within 12 hours. So we almost get a 24-hour service. We do some analysis here. Whatever the analysts have done here, they leave it for the India team. They pick it up. By the next morning, I come in and I pretty much have the breakdown of what the asset looks like.
Right. No, that's awesome. And then has your criteria changed with COVID-19 for Houston?
Too early to say. I haven't thought about it. I haven't thought about what the impact is going to be. I'm waiting to see the May numbers, and I'm waiting to see, and then being opportunistic, right? I don't know how the market will take it. It goes back to the loan. It goes back to the debt market and how the debt will be placed in this market.
Okay. And then, do you have any favorite Houston submarkets?
Favorite, I like Spring Branch quite a bit. It's hard to find deals in Spring Branch, but we have a lot of exposure. We have almost 2,000 units there. And that's one of the best markets. Westheimer I used to like, but that's probably one of the poorest performing sector. The West Chase and the the Wood Lake and the Galleria market, because there's so many apartments. So traditional thinking always says we own almost 3,000 units in that market. In those markets, and we've done okay. We've done decently good, but our expectations are much higher. But I think because of the competition, because of the supply that exists in that market, it's always a very challenging market. I really like. I would say Spring Branch is really good. I like certain spots of West Chase, like on the Briar Forest area. I like that market, Briar Forest, Hillcrest area. Then we have a lot of exposure in Clear Lake, Baytown. Those are decent markets. I love 290. I love the 290 market. Not Cypress, but on 290 Hempstead in that area. That area is also great for workforce housing. So we've done very well there.
Okay, no, that's awesome. And then, obviously you've spent a lot of time in building out your property management company. What are your thoughts on self-management versus third-party property management?
You gotta do your self management. I mean, we went through the whole drill in the beginning. We try to get somebody to third party manage, but the incentives are not aligned, right? Third party management companies get paid 3-4% of the revenue. But again, at the end of the day, as an owner, for you, a dollar in, dollar out has the same meaning. So for us, it's all about NOI and the net cash flow. But we hands down, if anybody has aspirations to get into multifamily, I would really consider self-managed, because that is the only value proposition you're bringing for your investors, right? Because otherwise, as an investor, as an LP, why are they giving you the money, right? They're basically giving you the capital so that you can add value. What is my value add? My value add is not just limited to finding a deal and raising money and closing it, right? My value add is buying a deal which NOI is at $100. I'm gonna take the NOI to $120, right? That's why I say that you have to self-manage.
No, that's great. And then, are there any KPIs that you particularly focus on? As you look at your portfolio?
We look at a lot of things. So we look at the renewal ratio. We look at the traffic, the foot traffic, the walk-in, what percentage of the traffic got converted into leases. We obviously, the big numbers, obviously everybody knows: the gross collection, the delinquency, what delinquency percentage you're closing at, the concessions. And then expenses are a big part. We want to make sure that expenses play a big role. Make sure that we have the expenses tied down as much as we can in our control.
Okay, awesome. And then, you had talked about providing a safe and secure, clean environment for your tenants. Is there anything else that you think, residents want? And, what's the kind of the highest ROI, amenities that
I would
residents are
say
looking
that's
for?
probably the best thing. Yeah, you provide them with a nice security, clean, safe place to live, a playground for their kids, a nice, clean, open pool during summertime, and a fitness center. I mean, if you can provide these basic things, I think most of your tenants will be very, very happy.
Yeah. And then Swapnil, you touched on this earlier about Karya Cares. Walk us through some things that have been most impactful to the community and your residents.
It's a great initiative we took, and especially the background where we come from. We want to make sure that we want to create a win-win-win model for everybody, right? So win-win model is win model for great returns for investors, great, secure, happy place for our employees, and then most of all, make sure that our tenants, where they're living, is a place that they want to live and get happy where they're living about. So, Karya Cares is very close to our heart. So we actually have a lot of initiatives we're taking. We are actually opening a free healthcare clinic, in fact, on May 1st, which is going to be a 100% free healthcare clinic for anybody and everybody, open 8 hours a day, and the goal is to keep increasing the hours. We have a lot of volunteer doctors, and have full-time nurse practitioners.
And
the
where
goal
is that, Swapnil?
I'm sorry?
Where is the healthcare clinic?
It's going to be located at one of our properties called Bella Vista, which is on Westheimer and Dairy Avenue.
Wow, that's awesome.
So that's one of the big initiatives we took. And then another big initiative is the rental assistance. Even before the virus, we had put aside a lot of money to, every month we were picking about 30 to 40 tenants who genuinely couldn't afford to pay the rent. And they've been good, long-standing tenants. And now because of the virus, we just expanded that quite a bit. And that's very, very, effective. Where people have been living for 2, 3, 4 years, never missed a payment or never missed their rent. And all of a sudden, because some financial hardship, they cannot pay. And we come in and pay for them. It's just unbelievable. Their reaction, the feelings that we see, it's unmatched. And that's what life is about, right? Giving back. Another initiative we do is free swimming classes for everybody, all the kids in our communities, because as you know, the number one reason for drowning in apartment communities is drowning. The number one reason for death. So we're providing free swimming classes. Then we have a free meals program for kids through Be a Champion during the summertime. Then we partnered with Rose Group, which provides free mammograms for all the women. It's a mobile ambulance that goes from property to property. It does free mammograms for all the women at our property. So, we keep adding on these initiatives. Our next initiative is I want to start a microfinancing or a microfunding platform for tenants where they can borrow So, a lot of our tenants are, blue collar tenant base that we have, workforce housing. A lot of the people, when they run into financial distress, they go to these cash payday loans and
Sure.
pay 25, 30% interest rate. I want to be able to provide them loans at very reasonable 3, 4, 5% interest rate that they can pay us back over time. That's the next initiative that we're working on the platform. So these are all real solutions, real problems. And as a business leader, as an entrepreneur, I mean, if I can add a little bit to that, I think that would be great for everybody.
That's awesome. That's so inspiring. Really appreciate you sharing that with us. As we wrap up here, what advice do you have for people getting into the business, both passive investors and first-time syndicators?
Yeah, if you're a passive investor, I would say that invest in people, right? Invest in who you're giving the money to, right? And it's not about the deal. It's about, when I started this business, I used to, when I was trying to raise money, it was very hard. I used to tell them, if you can't look me in the eye and trust me, then you shouldn't invest, right? And so invest in people who know that will safeguard, will be a good fiduciary for their money. For syndicators who are actually doing it themselves, make sure that you have a good heart, or work with high integrity, right? Always put investors' in interest first before yourself. We've had, as you know, we have 70 assets. There's times where some asset might not perform, or because we do quarterly distributions. So there's times when the property doesn't generate enough cash flow, or it generates enough cash flow, but not enough for distributions. And we put investors' interest in, we defer our fees so that we make sure the investors get their distribution. Because again, like a passive investor, they're used to their mailbox money every quarter. We want to make sure that we keep fulfilling that promise of the quarterly distribution.
That's awesome. That's awesome. How can listeners get in touch with you?
I think LinkedIn is the best way. LinkedIn has my email address, my mobile number. I check that pretty frequently. That's the only social media platform I'm on. And if you get any contact, you can obviously direct them to me or my assistant.
Yeah, no, that's great. Well, Swapnil, thank you so much for covering so many topics, so succinctly, and, just an inspiring story. I really appreciate it. I love reading, kind of following your path in the press and so forth. So it's an honor to have you on the show.
Thank you so much. It was an honor to be on your show.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.